So, dear class, today's chapter will be about strategy evaluation and the control. These are the contents. Evaluation and the control process, measurement of the performance, issues and performance management. Okay, guideline for the control, tools for the strategic evaluation and the control, strategic audit of the corporations. Here we are. C. Determine what to measure, establish predetermined standards, measure the performance. Okay, the number found, does performance match standards or matching with our goals and objective? Yes. Okay, no need to take any corrective action. If no, we have to take a corrective actions. This is all about strategy or firm performance evaluations. Okay. So performance, by the way, what is the performance and result of any activities? In case of strategic management, let's see, we are performing many activities. Okay, this is the one of activity I'm delivering your lectures. Okay, this lecture can be effectively delivering the usable informative knowledge to you people. Okay, you are also taking this knowledge as enhancing your knowledge about to the strategic management, which you can use for your future career. Okay, and so how we can evaluate the strategic management performance? Maybe the through examinations. There are the different procedure and active steps to evaluate the performance, right? So one of the obstacle to effective control is the difficulty in developing appropriate measure of important activities and the outputs. Yeah, appropriate what measures we should use to evaluate the performance of any activities, right? This is the main concern. So in respect of light, see the how to say appropriate measure of steering control. What is the steering control? Basically steering control because they measure variable that influence future profit. Okay, future profitability. I mean future we predicting how uh, can earn, how we can take maximum benefit from the activity. Okay, from the firm. Yeah, in respect of any firm, they are looking for maximum profit, right? They wanted to use minimum input. Okay, and are and taking maximum output or maximum profit, I mean. Okay, anyway, measure variable that influence the future profitability. So some of the points in the steering, how to say, steering controls. Okay, suppose in respect of airline industry, one of the example is, for example, closely monitor cost per available seat miles. You also can see cost per available seat miles in airline industry. Suppose one of the example in 2002, Southwest airline, it's a maybe American airline. Cost per passenger mile was 7.5, the lowest in the industry. Contrast with United, okay, 11.5, the highest in the industry. Its low cost gives Southwest a significant competitive advantage. By 2011, Southwest cost had risen substantially to $12.5, while United have moved to 16.6. In the meantime, Southwest had been replaced as the most lower cost airline by Spirit Airline, whose cost maybe 2011 was 10.1. Anyway, it's mean how competitive advantage is also leading for the higher performance. In respect of Malaysia, which airline is offering low or maybe the affordable prices as compared to other competitors? Which airline is more low cost? Group 10. According to my information, AirAsia, right, is a low-cost airline in the Malaysia.
Yes.
Yeah, as compared to other airline like Malindo, like Mas, right? Even other Emirates, whatever other airlines operating. I mean, domestic operates, domestic or not international. How many airline are working in Malaysia domestically? Domestically, I mean local. How many airlines? Number one is Mas. Number two, AirAsia. Number three, Malindo, right? Number four, Firefly.
Firefly?
Yeah. Is it also working in Malaysia? No.
Yes.
You're not sure? Yeah, yes, I think. Anyway, second one is that, inventory turnover ratio for the retail businesses. For example, of steering control used by the retail store in the inventory turnover ratio in which a retailer cost of goods sold is divided by the average value of its inventories. This measure shows how hard an investment inventory is working. The higher the ratio, the best. Higher the ratio, the better. Yeah, it's the better. Not only does quicker moving inventory in tie up less cash in inventory, it also reduces the risk that goods will grow obsolete before they are sold. A crucial measure for computer and other technology items as well. For example, Deep, Office Depot increased its inventory turnover ratio from 6.9 to 1 year to 6.9 to 1 year to 7.5 the next year, leading to improved annual profit. Yeah, this okay. This is the one. And other criteria is the customer satisfactions. Customer satisfactions. Let's see the customer satisfaction. How? Another steering control. Basically, number one steering control is cost per how to say cost per seat mile, inventory turnover, and the third one is the customer satisfactions. These all three steering, you know, control elements are working to measure the variable that influence future profitability. Yeah, these all variables are helping to the companies for the future profit, how they can earn maximum profit in the future, I mean. Okay, anyway, in respect of customers satisfaction, research revealed that companies that scores highs on American customer satisfaction index, okay, this is one of the index which conducted a research, a measure developed by the University Michigan National Research Center, have higher stock return and better cash flow than those companies that score low. Okay, a change in the firm customer satisfaction typically works its way through a firm value chain and it's eventually reflected in quarterly profit. Anyway, main thing is the customer satisfaction. How we can gain the customer satisfaction? There are the many things, by the way. Okay, if you have a suppose if you have a high customer satisfaction, it's mean you will have a high profit. Simple outcome now. This is the simple outcome. And you must know about the performance measurement is conducting in two way. One is the objective measures, second is the subjective measures. For the objective measure, companies are using the data, secondary data, available data. Okay. For the subjective measure, they are conducting different survey like questionnaire. They are distributing questionnaire. They are conducting interviews. They are observing. Okay, let this further. We can discuss these two concepts as well. Anyway, so further, this slides. This is about the types of controls. There are three basic types of control: output control, behavioral control, and the input control. Output control specify what is to be accomplished by focusing on the end result. Yeah. of the behavior through the use of objective and the performance target of the milestone. Basically, so to be accomplished by focusing on the end result through the use of objective such as sales profit. This is a sales and profit. This is a purely ob- objective, how to say, purely objective measures. Here maybe I should bold it now. Yeah, see, objective measures such as sales and profits, we could, okay, subjective measures such as the customer satisfaction. Anyway, behavioral control, how something is done through policies, rules, standard operating procedure, orders from the supervisor, such as setup guidelines, standard SOPs means standard operating procedure, control employee direction behavior, work process, etc. And the third one is the input controls. Emphasize resources such as knowledge, skills, abilities, values, and the motives of the employees. And some of the organization they offering some of the systems which make sure the all three controls like ISO 9000. They are asking, okay, which company, any company which has a ISO 9000, okay, 9001, 2, 3, whatever, they have different version as well. These companies must have a record about output control, behavioral control, input control as well. The further advanced version of 9 ISO 14,000 series of quality standards establish how to document the company's impact on the. They should not only have the qualities, they should not only have the control of internal control, I mean output control, behavior control, input control, as well as the impact of the environment. I mean, in simple words, they should not only have considering about the product quality and the customer satisfaction, as well as they must consider the environment as well, how they impacting the environment, okay, how they sustaining. They must work on the green environment as well, I mean green environment as well, understand. you know One of the example of the manufacturing industry, they're polluting the natural environment, right? Because they're discharging the carbon, and the carbon is not good for our environment, right? Or might be some of the tenantries, I mean tenantries, they polluting the water, or maybe polluting our land as well, garbage, many things. So they also must work on it. Green environment. Their product should be a green product. Okay. The further slides is about. We already discussed the controls of types of controls. Now another one is the activity-based costing ABC. Basically, this is a recently developed accounting method for allocating indicate indirect and the fixed cost to individual product. I mean, allocating indirect and the fixed cost to individual product or the services on the value added activity going into the product. This accounting method is very useful in doing a value chain analysis of the firm activities for making outsourcing decision. Yeah, one of the things they are using for outsourcing, they are using ABC analysis for outsourcing decisions. Might be they should go for the outsourcing or should not go for outsourcing, like that. Now, basically, traditional cost accounting in the what was doing traditional cost accounting, focusing on valuing a company inventory for financial reporting purpose only, just reporting the purpose to obtain a unit cost. Okay, cost accounting, typical added direct labor to the cost of materials. Yeah, maybe they had focus on direct cost only. Then they computed overhead cost as well, from the rent to R&D expenses, salaries based on number of direct labor hours. Okay, that obtained unit cost, they divided the total number of before they were just considering the direct cost and calculating the total cost of the product. Now, ABC system or analysis suggesting them they must add the overhead cost and then calculate the total cost of the product or the services. Anyway, further, here for more clarifications, activity based costing is the method of assigning overhead and indirect cost such as salary and utilities to product and service. Yeah, they are calculating, so assigning overhead cost, their main concern is overhead cost. The ABC system of cost accounting is based on activities which are considered an event, unit of work, task, whatever. Activity cost drivers such as the purchase of order to machine setups, even the maintenance of setups. This is the example. The cost driver rate, which is the cost pool total dividend by the cost driver, is used to calculate the amount of overhead and indirect costs related to the particular activities. Okay, in ABC analysis, they are calculating overhead, indirect, and the direct cost. Then they will have the final cost of any product and the services. Maybe cost accounting student will have a more deep understanding of this ABC analysis. Okay, there are any accounting student in our class? I know many, but they don't want to participate. No worry, no problem. This is the example of ABC analysis. Machine setup cost, product quantity in the batch. See, these are the all overhead cost per machine hours, production hours, except direct cost. See, traditional cost, here, you can comparison ABC model and the traditional costing. What they were doing in the traditional costing, only products quantity in the batch, 16,000. And then overhead cost here, okay? And then production volume per machine, 50. Overhead cost, 20. But they missed this one, setup cost per unit. They missed this cost, okay? They missed this cost. Got it? Hope you understand. Hope you understand. Anyway, further one, another criteria. Earlier, I already told you this chapter is why this chapter is very important. Please see this slide. Why this is important? Here, here. Okay, does performance match standards? Yes, no need to take corrective action. If no, then take corrective action. We have to revise our strategy. Understand? So these are the criteria we making sure or we evaluating the performance of our firm. Understand? Suppose in respect of strategic management, what we will do, examination will be the criteria to evaluate your performance. Okay, if you pass, if you will have a passing marks, you will promote. If you will not have a passing marks, you have to revise this course again, right? This is the best example for you people, for your better understanding. Anyway, enterprise risk management. What is this basically? This is integrated process for managing the uncertainties that could negatively or positively influence the achievement of the corporation's objectives. Yeah, in the past, managing risk was done in a fragmented manner with functions or business unit. They were not serious, by the way. In other words, simple words, individual would manage our process risk, safety risk, insurance, financial, and other assorted risk. As a result of fragmented approach, the companies would take huge risk in some areas of the business while our managing substantially smaller risk in other areas. So this one, the fragmented, this is the traditional approach. How about the ERM, mean enterprise risk management, is being adopted because of increasing amount of environmental uncertainties, which we covered in our last chapters, external environment and internal environment. Anyway, entire the huge amount of or a huge amount of environmental uncertainty can affect the entire firm, entire company, entire corporation. And What will the result? As a result, the position chief risk officer, one of the fastest growing executive position in even USA, in any other developed companies, they hiring chief risk officer. What is their responsibility? Okay, suppose Microsoft uses scenario analysis to identify key business risk. According to the Microsoft trier, the scenario analyses are really what we are trying to protect against. The scenario were possibility of earthquake in settled region, major downturn, basically another. And if you must have an understanding about the ERM. ERM giving you a future prediction, future forecasting. I mean, future forecasting. What will be the worst in the future? They are looking, or they are foreseen for future foreseen. Suppose might be currency rate is increasing. Oh, might be currency will be more higher in the future. We must buy the raw material and we must tackle the currency, you know or might be they are forcing, okay, the instability in the politics in the country, like even suppose in the USA, in the Malaysia, in the even Pakistan, in other countries, politics in the not stable, might be in with the more worse in the future. What we should we do if more worse, like COVID-19, unpredictable, okay, getting worse by worse, how we do? So they are planning to tackle the uncertainty by the way. Okay, suppose the process of rating risk involve three steps. Identify the risk using scenario analysis, brainstorming, performing risk, or self-assessment. Number two, rank the risk. Okay, which rank we already did by the way. The factors, those are the opportunity, threats, and we also it's belong to the risk lah, like risk and the weaknesses. Basically, these are the potential risk by the way, and we must rank it. Okay, which is more worse, which more is important to tackle at first priority. If we couldn't respond to that risk, might be can be a more harmful for us. If we tackle that risk, that will give us a maximum profit by the way. Understand? Okay, rank the risk using some scale of impact and likelihood. Measure the risk using some agreed upon standard. Yeah, there is a different standard. Okay, suppose one more thing, one more information for you people. Some companies are using value at risk, VAR, not ERM. This is another system. VAR, effect of unlikely event in the normal market. Yeah, unlikely, which you don't like. And the stress testing, effect of events in the abnormal market methodology to measure the potential impact of financial risk they face. I mean, DuPont uses earning at risk, EAR, measuring tool to measure the effect of risk on reported earning. Yeah, okay, ER later, but you must focus on the enterprise risk management by the way. Anyway, primary measures, further slides. This is about primary measure for the corporate performance. When simple financial measures such as these are the, we also can say traditional financial measures. What are the traditional measures? Okay, so return of investment, EOI. Okay, or we also get earning per shares. This is another one. Basically, return of investment or EPS were used alone to assess overall corporate performance. Always no recommended broader range of methods to evaluate the success or failure of the strategy. Yeah, might be failure of the strategy. Now they have the, some of these methods are stakeholder measure, shareholder measure. Yeah, basically, this second slide, this is about. See, non-financial measure. Sorry. Should be here. This one, here. This slide. And this slide, these are the, traditional financial measures. And now tackling these, maybe some of disadvantage of these measures. Then they introduced these measures. Shareholder value. We will discuss one by one. First, discuss this one. Traditional measures. Might be some of the students from financial or finance background or accounting background, they will have a more understanding about this one. Very simple, very simple. We all have maybe battery saver. Okay, wait, battery saver. I already battery save. No, battery saver. No, considering 20%. No problem. Anyway, come on the point. Basically, let's again financial. The traditional measures such as ORI and EPS were used alone to assess overall corporate performance and coming to an end. So analysts now recommended a broad range of methods to evaluate the success or failure of the strategy. Some of these methods are stakeholder measures, like shareholder value and the balance scorecard. And that's our third slide will be the balance scorecard. This criteria. See this criteria, all three criteria. They asking, yeah, you can go for this criteria as well as along with this criteria, we must use this criteria, shareholder value as well, and as well as balance score card as well. Only not only using this all criteria, return on investment, result of delivering net income before taxes by total amount invested in the company. Okay, you may have a okay divided net earning by the amount of, these are the ratio might be you taught already before. Return on equity involve dividing net income by total quality. If you need, I can explain one by one, or just have an idea. Simple, have an idea. What is this? Might be you have one. Suppose return on, return on investment. It is simply the result of dividing net income before tax by the total amount invested in the company, typically measured by the total investment. Although using return on investment has several advantages, it has several distinct limitation as well. Okay. By the way, let's discuss the earning per share EPS, which involves divided net earning by the amount of common stock. Also has several deficiency as an evaluation of the past and the future performance. Anyway, okay, let's. So operating cash flow, the amount of money generated by the company before the cost of financing and the taxes. Yeah, very simple. Amount of the, you know, operating cash flow, the amount of money generated by the company before the cost of financing and taxes, we already done, is the broader measure of the company funds. This is the broader. This is the company net income plus depreciation, amortization, interest expenses, and income tax expenses as well. Some takeover specialists look at much more our free cash flows. Another one, the third one is the free cash flow. The amount of money a new owner can take out of the firm without harming the business. This is the net income plus depreciation, depletion, amortization, less capital expenditure and dividends. The free cash flow ratio is very useful in evaluating the stability of an entrepreneurial venture, I mean new businesses. Although cash flow may be harder to manipulate than earning, the number can be increased by selling account receivable, classifying outstanding check as account payable, trading securities, and capitalizing certain expenses such as direct response advertising. Many more, by the way. Anyway, let's discuss the further shareholder value. Basically, first, because of the belief that accounting based numbers such as return on investment, return of equity, okay, earning per share are not reliable indicator of the corporation economic value. Many companies are using shareholder value as a better measure of performance and strategic management effectiveness. This is the one other reason why they are using share value. Now we can discuss one by one. Might be I will discuss one. Shareholder value can be defined as the present value of the anticipated future stream of the cash flow from the business plus the value of the company if liquidated. Anyway, how about the others one? Other one is economic value, EVA. EVA has become an extremely popular shareholder value method of measuring corporate and the divisional performance, and maybe its way to replacing return on investment as a standard performance measure. Yeah, it's replacing return on investment measure. EVA measures the difference between the pre-strategy and the post-strategy value for the business. Understand? This is the advantage. Market value added, MVA. How it's working? Difference between the market value of the corporation and the capital contributed by the shareholder and the lenders. Like net present value, it's measure the stock market estimate of the net present value of the firm from past and expected capital investment projects, such as MVA's present value of future EVA. Yeah, this is a different one. Add all capital that has been put into the company from shareholder. Okay. Number two, reclassify certain accounting expenses such as research and development. Number three, using the current stock price. These all things are, added in the market value added. Anyway, market measures stock my estimate of the net present value. You know how to, how much the shareholder, how much they have earning. Basically, the shareholder, these all criteria is telling to the shareholder how they increasing their wealth. Is they increasing their wealth or decreasing their wealth? No, non-financial performance. Okay, one of the examples. So internet business ventures. This is the subjective measures, by the way. How they measuring their performance? See, length of website visits, how many, number of people who visit the websites, and brand awareness. If they have a more, they just separating the brand awareness. This is for your information. The third one is the main criteria, balance score. Basically, rather than evaluate a corporation using a few financial measures such as NPV or ROE, RE, NPV, like that, we can say cash flows, free cash flows. Anyway, so once again, rather evaluating a corporation using a few financial measures, balance scorecard that includes non-financial as well as financial measures. Yeah, what is the benefit of the balance scorecard? It's combining financial measures as well as the non-financial measure together, and it has the three main components, by the way. See, financial, how do we appear to shareholder? Financial ratio, profit, equity, number. These criteria they are using. Customer, how do customer view us? Customer survey, brand, product, customer experience. Okay, customer survey, you mean different question here, interview. Number three, internal business perspective. What must we excel in? Business practices. Okay, we have to evaluate our businesses practices. Which practices need to improve? And the third one, innovating and learning. Can we continue to improve and create value? See, R&D, research and development, learning, training, employees, new training, new technology. Key performance measures, measure that essential for achieving. Okay, but focus on the 3-4. Okay, furthermore, some of the history about what is the balance score. You may read this whole slide. I can read for you. Balance scorecard is a performance metric used to identify, improve, and the control business various function. Yeah, all activities which they are performing, which they are working on it. The concept of balance scorecard introduced in 1997. Who? David Norton and the Robert Kalpan. Anyway, number three, balance scorecard was originally developed for the profit company, but later they adapted for the non. Yeah, this criteria we can use for profit companies as well as non-profit companies as well. The balance scorecard involved measuring four main aspects of the business: learning, growth, business process, and the customer and the finance. Yeah, we covered here, by the way. We discussed here. See, four criteria. Okay, balanced scorecard allow company to pool information in the single report to provide information into service and quality and decision financial performance and to help improve efficiency. Yeah, basically. Okay, this is the example. This is the example. Might be we can have a more understanding about it. How? I should. Oh, camera off. Oh, okay. More understanding about here. Vision. What is the transforming society through the provision of ultra high speed mobile transformation services? Vision. What is the vision? Mission. The number one provider of ultra high speed mobile network and content to the customer. This is their objective. How to achieve these missions? Okay, let's see. First, organizational capacity, improve knowledge skills, improve content supply, improve technology. Internal process, improve offering selection, improve information, improve ease of use. These are all activities now. Number three, customer, improve clarity of offering, improve market perception, improve end user. Now, the main thing, increase revenue, increase profit, increase operating cost. I mean, the main function of any company, they are working on, you know what they are working? They are looking for minimum input and maximum output, gaining for maximum output. Understand? But they cannot achieve except these all three steps, except these must include customer internal process and organizational capacity. That's all for today lecture. For next lecture, we'll cover further part, responsibility center, etc. Okay. Now we can move for our today presentation.